Hi everyone, welcome to Blue Sky Binary's Proper Money Management in Binary Options webinar. Agenda for today is to quickly discuss price action versus mean reversion, the two main types of strategies you can use to tackle binary options. And then secondly, talk about setting your risk levels when trading binary. A quick legal disclaimer follows. Blue Sky Binary assumes no responsibility for any potential errors, inaccuracies, or omission in this material. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Binary options trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in binary options, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and binary options trading and seek advice from an independent financial advisor should you have any doubts. This presentation is copyright of Blue Sky Binary. Reproducing, forwarding, or reselling this material is strictly prohibited. Okay, so getting into the meat of things, all types of strategies that you may deploy in currency trading or different types of asset trading, generally speaking, fit into two pockets, two types: price action and mean reversion. Now, price action is more powerful. The trend is your friend. You may have heard that colloquialism quite often, but identifying it is a bit more difficult as the trend generally needs to be fueled by an exogenous macroeconomic event that can cause the trend to perpetuate and continue so that you can enter and exit safely. Mean reversion is more common. Price generally tends to move in waves in the market, and it's more easier to identify and can also be profitable. Both the above strategies, however, whether using price action or mean reversion, do require proper money management. And indeed, it's almost 80% of the equation in order to manage your money. Not losing capital in the binary option space is almost like winning capital in the long term. So even if you are winning trades, if you don't have a proper money management system in place, you may lose overall because you're not engaging in correct position sizing. And we're going to go over this today. So the first tenet of proper money management is determining the account size. Having too little money in your account can pose a problem. Firstly, there's a psychological impact of working really hard to identify trade setups and then entering the trade and then going through the motions while the trade is in progress, and that can be a wild ride sometimes. And then at the end, when you win, you do want to be rewarded with a decent payout. If you're taking $5 trades, $10 trades, the payouts just in absolute dollar terms are not worth your while. And so this could lead to over trading. If you have a target of making $200 to $300 a day and you have a capital account of only $200, safely you'll only be able to make $10 to $20 a day, and then you start to overtrade because that's not enough. So small capital balances are actually risky and bad for you. It can result in trades being taken that are too high as a percentage of your total balance, and this just results in excessively risky trading. So in our view, a good amount to start off in binary options is between $500 and $1,000. Anything more than $1,000 may result in an opposite phenomenon, that's lack of respect for your capital. And you're taking more undisciplined trades because you just don't respect how much capital you actually have there. And if you have very large binary option accounts, sort of $10, $15, $20, $30,000, that is extremely irresponsible trading because it's not like currencies where you are making bets, you're making money on every pip that goes up or down depending on if you're long or short, and you have lot management and lot sizes and stop losses in place. It's a completely different animal. In binary options, you can win by 1 micropip if the price is above or below your desired rate at expiry, and you can get up to 70 to 80% of your entire investment as a return. So you don't get that in any other market, but therefore also you don't need a lot of money in your account. You need a strategy that is more than 59% accurate or has a over 59 to 60% in the money rate. And then even with an account of 500, you can make a lot of money. So once you've determined your account size, then the question is, how do you determine risk levels and position sizing? So most brokers will tell you that 5% of your capital is fine per trade. This, in our view, is excessively irresponsible and very risky. It's also very ill-informed information. If you go to the equity markets and you look at how fund managers, especially in hedge funds, are taking risk positions by investing in different companies, you'll notice that no single position represents more than 1% of their capital. In some instances, might be 2 to 3%, but it's quite rare. So why should it be different in the binary options marketplace? So if you have a small account, however, let's say $200, which in our view is dangerous trading, then $10 per trade or 5% is fine because it's only $10. But if you have a $10,000 account, then 5% of capital per trade is not fine, right? $500 per trade is excessive levels of risk in absolute dollar terms. So in general, no trade should be more than 1 to 2% of your capital. That's our rule. And this would mean on a $500 account, $10 is fine, $10, $15 per trade. Another thing is per day, your account should not suffer a drawdown of more than 5%. If it does, you must log off and live to fight another day. If you continue, there is a high chance you may revenge trade or overtrade in order to compensate your losses, and this will result in you blowing your account eventually. So once you have determined your account size and your risk levels, then the question is, okay, once you're in the trade, what happens if things go wrong? What do you do? A very common practice engaged in binary options is martingaling. And what that basically means is that if you enter position 1 and it goes against you, then you enter the same direction, another position, but twice your original bet. Now, if you get a bad entry price, certain traders may top up their positions, and this done within reason can actually increase your profits over time. So I think martingaling has received a very bad name in the industry because A, it comes from the gambling industry, and B, it's done very irresponsibly where people just keep opening positions after positions, and before you know it, your entire account is wiped out. C, the market can remain in a particular direction, trending in a particular direction, longer than you can remain solvent. You know, you have maybe a few $1,000s in your binary options account. The market has 5 trillion of liquidity daily that it can throw against you if it wants. So our view on martingaling and adding to positions when you are in loss is always follow the rule that in total the opening position plus any top-up position that you have taken, i.e. the martingale, doesn't represent more than 2% of your total capital together. Okay, if you start opening a third martingale and fourth and fifth, you've already lost the trade. Now you're just betting on hope. So that is the webinar. It's determining your account size, determining your risk levels, and then knowing how to manage losses or non-crystallized losses when you're in a trade. And if you have any other further questions, you can contact us at support@blueskybinary.com or add us blueskybinary on Skype. We are located at www.blueskybinary.com. Have a profitable week ahead. Thank you.